Most people in crypto have it completely backwards. Most people use approaches that are okay for the stock market in the crypto market as well. But crypto works completely differently. In crypto, we cannot use diversification. We cannot buy 100 different altcoins and hope to outperform. We also cannot do much of fundamental analysis because very often it's rather the narrative of the day and it's psychology that actually drives prices. We cannot use approaches like estimating future cash flows and discounting them to today and sum up all of those cash flows, estimate the fair value, because very often we do not have even any cash flows. Really, the only thing that I believe works is the psychological anchor point. Where is the current price relative to, for example, the average cost basis of the market? How much is the market currently in profit or in loss? This is what we see here in the background in this chart. This is the net unrealized profit and loss for Bitcoin. It comes from the website looknode.com, so feel free to check out that website. But it shows us when people are in a lot of net unrealized profit that the market might realize some of that profit. And realizing profit means nothing but simply selling Bitcoin and starting a potential bear market. For example, over here, the net unrealized profit was at 80% for the entire market. Over here was at 78%. Over here, it was at 72%. So when many people are a lot in profit, selling is much more likely. People rebalance their portfolios. The same is true the other way around, right? When a lot of people are in net unrealized losses, so for example here, the entire market was around 30% in losses, then the selling pressure tends to slow down. Because if you believe in Bitcoin over the long term, and if you think that the tokenomics of Bitcoin are better than, say, the tokenomics of fiat currency, then over time, of course, Bitcoin should go up measured in US dollars. So when you're currently in losses, you might be less willing to sell unless you really have to. So there's less selling pressure when people are in losses. There's more selling pressure when people are in profit. Currently, by the way, we are somewhat in profit, 54%. We are not yet at those records highs. We are not yet at 70%, and we did go down in terms of net unrealized profit in the last 1.5 years. So the market today is less heated than it was at the beginning of 2024. But still, buying today is definitely not as great compared to buying when the market is in losses, right? When Bitcoin was only at around 20K. Instead of looking at the net unrealized P&L, we can also have a look at what percent of supply is currently in profit. So this oscillates between 100% and 0. It tends to never hit 0 because Bitcoin goes up long term, but it also gives us a nice way to determine, does it make sense to potentially go against the current momentum, especially when the majority of the supply, the more than 50%, is currently not in profit. Now, fundamentally, here is what I think is going on. Why we even see those cycles, why prices go up very, very fast and then suddenly crash down again, then they go up again, then they crash down again. I think this cycle generation happens because there's a certain particular investor that just tends to dollar cost average into Bitcoin. So there's the long-term holders that just save in Bitcoin, they buy Bitcoin regularly, and thus they stabilize the price. But as the price rises, this creates a lot of attention, right? Traditional media talks more about crypto, the YouTube algorithm will play out more crypto videos, etc. And so new people enter the space. And as new people enter the space, because they want to be part of the rally accelerates more and more. But the end of that acceleration, the end of that bull market is very, very fragile because the short-term holders, they don't necessarily buy in order to hold Bitcoin for the very long term. They just want to be part of the current rally. And if then the rally stops because there aren't enough new people coming in, if there's a little bit of an inflection point, that's then when the bear market starts. That's then when there's panic selling. That's then when the majority of supply turns into losses. So that's when the short-term holders are giving up and still a few long-term holders continue dollar cost averaging in, creating then the final floor. And so the cycle repeats. And we can even see this in charts like this. This is the realized cap hodl wave. So it looks at who is realizing their profit or their loss at different points in time. And we can see that there's a lot of short-term trading happening at the end of a bull market. This is when the market is the most fragile. However, when there's mainly long-term holders that dominate the price action, that's when we usually tend to bottom out. And so currently there is still quite a bit of short-term speculation in the market. We are not yet at historical heights, and we do see a tendency that over time more and more Bitcoin is held by the long-term holders. But we have to be careful, right? When Bitcoin hits 150, 160, 170k, then the market might heat up again, and then it might make sense to also take some chips off the table. Again, now is of course not as great of a time to buy compared to, say, May of 2023. It doesn't look like we are now at peak mania, so momentum is still bullish, the market is still expanding, but we have to keep an eye on whether or not things will accelerate. Fundamentally, the price discovery in crypto is all about psychology. It's all about the anchor point, maybe the purchase price that you bought at, maybe the average price in the last year. It's always about where is the current price relative to something else. And the nice thing about the data in Bitcoin is that we've got a much longer data series. And there is a lot of correlation between Bitcoin and many altcoins. When Bitcoin crashes, then of course the altcoins come with it. And the same is true the other way around. When Bitcoin rallies, the altcoins tend to appreciate as well. Now over here, we've got the AHR 999X index. It looks at the current price relative to the price in the last 200 days. So again, there are peaks, there are bottoms. And the market is not yet necessarily that heated, right? This is when we are in the red zone, but it is gradually heating up in the last 2 to 3 years. We just have to watch this closely. Still, the last 50% increase in Bitcoin or so was relatively healthy, as in we did see a lot of profit taking and rather a slow appreciation. That's how I interpret the data. Is still appreciating in a healthy manner. Now, this idea that in the bear market, when everybody is rather calm, that it's mainly the long-term holders that generate prices through their dollar cost averaging, and that in turn in a bull market is mainly the short-term holders that just entered the market because the media is talking about it, this idea could also be interpreted as the long-term holders are dumping on the short-term holders, because the long-term holders are now in profit, the dollar cost average in, they have to rebalance their portfolio, they've got a lot of net unrealized profit, they're realizing that profit and they're realizing this by selling to the short-term holders that just entered. But there's an interesting measure that looks at the ratio of long-term holder trading versus short-term holder trading. And that's the realized HODL ratio. When this is very low, it's mainly long-term holders that are not trading. So it's wallets that held Bitcoin for at least 2 to 3 years. And when this is high, it's mainly the short-term holders. So that's only 2 to 3 weeks of holding period. So we can nicely see how transactions move from long-term holders to short-term holders back to long-term holders. So this is also a nice oscillator telling us when we are particularly cheap versus rather expensive. It tells us the exact same story, even though what we're measuring here is not the same compared to the other indicators. Still, we are not historically cheap. We are not extremely heated. We did come down in terms of activity in the last 1.5 years. So the market actually appreciated in a healthy way. And again, when Bitcoin hits 150 or 200k, this might shoot up again and we might take some profit. There is a case to be made that over time, more and more market participants become long-term holders. And that maybe future rallies won't be as aggressive anymore. Those tops over here, when there was short-term holders dominating the price action, they tend to come down over time. Have a look at this. We can connect those tops relatively well. It doesn't align perfectly for 2021, but we do have 4 data points that are relatively well connected. And again, if you just heat up a little bit in the market, it might make sense to at least temporarily rebalance a bit. Here's the market value to realized value ratio. So this looks at the current price relative to the average cost basis of the market. We can also adjust this for the volatility. And again, it seems like the tops are aligning somewhat. Not as well compared to the realized HODL ratio, because here we've got less of a history of alignment. We can't really connect the first data point, but still, I think that's quite noteworthy. I do believe though that this resistance is likely going to get broken. Here's the Maya multiple. Again, looking at the current momentum in Bitcoin. And again, we see how the data points somewhat align. Over time, Bitcoin becomes less volatile. And currently we aren't as heated compared to when Bitcoin was at 70k. But just a rally of 20 or 30% in Bitcoin might already warrant being a bit more cautious. Now, what's the potential risk in case we do not go any higher? This is now the realized price. So that is the average cost basis. The MVRV score looks at the current price relative to the cost basis. But just looking at the cost basis in isolation, we can see how whenever the price is below that cost basis, so when the market is in net unrealized losses, it might make sense to buy. Now currently that cost basis is at 53k only. I don't think that we'll get there anytime soon, but there is also another related indicator, and this could give us a bit more hope. This is the coin value days destroyed metric. And again, in the past, this was a very nice bottom indicator. It made sense to buy whenever you got close to that level. And that recently shot up quite a bit. It's currently at $94,000. And that would be quite nice if that's actually now the bottom for the market. Historically, this indicator worked very well. It doesn't mean that it has to work in the future, but it gives us a potential first entry point in case we suddenly do turn around and get a bit of a correction, right? At 94k, or maybe even 95, 96k, it might make sense to do a first counter-cyclical purchase. So buying when in general most people aren't that bullish. The narrative today is very different to the narrative just 3-4 years ago. Now it's all about the purchases through the Bitcoin treasury companies and through the Bitcoin ETFs. And the great thing about those entities buying is that they tend to just accumulate. They tend to not sell. At least historically, they've never sold over the long term. This balance just tends to go up. And because this is rising quite fast, as in Bitcoin mining is only at 0.8% per annum, but those two entities combined, they bought more than 1 million BTC in the last year. So they absorbed more than 5% of the supply. That tells us that Bitcoin does become a scarcer and scarcer asset over time, while fiat, of course, expands in supply every year by 6.8% roughly. That's why long-term Bitcoin has to go up. Again, the market is still clearly bullish. I don't have a crystal ball, but we do see regularly more money flowing into the space. This is a stablecoin market cap. And since October of 2023, this is going up. And of course, as more fiat currency gets converted into stablecoins, this will then eventually get swapped into Bitcoin and into the altcoins, which will then push up US dollar valuations. In the short term, things can of course be slightly different. So at the top, we see the stablecoin dominance. How much percent of all of crypto is in stablecoins? And at the bottom, we see the Bitcoin price. So there is a negative correlation between the two, right? When there is more stablecoins on the sidelines, crypto prices tend to go down. When those stablecoins get deployed, then crypto prices go up. And in the last 1.5 years, we have been trading in a range. And if we stay within that range, then there's a chance that Bitcoin could rally for a bit to then subsequently do another correction. But maybe that correction will already stop at 94k, as the CVDD indicator suggests. So again, I'm just showing the data. I'm not pretending that I know where things are going. I am quite exposed to Bitcoin and to crypto as a whole. And I continue to watch those indicators to then find good opportunities to take some profit as well. This is where most people do not succeed. It's actually taking profit that's much harder than buying for low prices. Now, there is somewhat of an argument to be made that altcoin season might be imminent. And so that's based on the others dominance chart. It shows how much of all of crypto in percent is currently in the altcoins that are not in the top 10. And this seems to bottom out at very similar levels, and it might have just bottomed recently. In the past, when we were at similar levels, the altcoins outperformed the rest of crypto by more than 300%. So I understand this argument, but there's a bit of a problem with the argument because the other dominance measures the market cap, but market cap is a very different thing to prices. There's a dedicated website called Tokenomics AI that does nothing but measure the token inflation of various altcoins. So let's have a look at Aptos, for example, here at number 1. This is the Aptos price relative to the altcoin market cap. Since March of 2023, this went down by 88%. And the reason is an ever-expanding token supply. As there's more and more tokens hitting the market and supply is higher than demand, then of course the price has to go down, at least relatively speaking. This is the Aptos market cap chart over time. It's at very similar levels compared to February of 2023 at roughly 3 billion, so barely a change. But in February of 2023, the Aptos price was at $18. and now it's at $4.39. So this is how much impact token inflation actually has. The other's dominance does not look at prices, it only looks at market caps. But we do not get market cap returns, we get price returns. Market caps can be unchanged, prices won't be unchanged if the supply just keeps on increasing. Now, how much of a problem is this really in the grand scheme of things? Is this just a few select altcoins, or do we see this on a broader scale? The answer is somewhat depressing. We unfortunately do see this on a broader scale. So each week we see roughly 1 billion worth of token unlocks. If we do not see at least 1 billion of additional demand coming into the altcoin market every single week, then the prices have to come down. The other's dominance might be unchanged, but the price of individual altcoins definitely do get negatively impacted. Aptos is currently the 42nd largest cryptocurrency. It's just an example. Let's have a look at the top 100 cryptocurrencies. In the last year, Bitcoin went up by almost 100%. We've got 26 out of 100 altcoins that did better than Bitcoin. 73 altcoins did worse than BTC. And so here's what I personally do. I'm simply just betting on bad altcoins to continue to do worse. So we can just flip this chart around. This is the Bitcoin price relative to the Aptos price. At the bottom, we've got the others dominance again. So the others dominance did not change at all in the last 2 years, right? It went flat while Bitcoin's price relative to the Aptos price appreciated by 400%. So this is really where I believe the alpha in crypto is. It's the market inefficiency of highly inflating altcoins. I'm following this strategy already for roughly 4 years. So I'm betting on poorly performing altcoins. I'm betting on them to go down further, while I'm betting on rising Bitcoin, Ethereum, and Solana. And because of that, I outperformed just dollar cost averaging into Bitcoin. Dollar cost averaging into Bitcoin is shown here as this light gray line, but I got the performance that's shown in the black line. So there is a way to beat the market without trying to find the few winners. We can simply bet on the market structure, on the constantly increasing token supply of many altcoins. It's maybe not as straightforward as just buying a single token. Some things have to be learned, but that's why I made dedicated videos on the topic. I try to make this as simple as possible, so there's really only 2 videos that have to get watched. The first video is using perpetual futures to bet on relative valuations. The second video is risk management with relative valuation bets. Once you've watched this 1 hour of content, you know exactly what to do to get this kind of performance, to set up positions like this. After you've watched those 2 videos and you've joined the community, I will send you my favorite trade that looks very similar to Bitcoin relative to Aptos. If with that trade you do not make money after 1 month of holding the position, then I will refund the membership fee to you. So those $125 are actually not what you're risking. If you don't make money with this favorite trade, you just get that money back. Just message me and I'll refund you, no questions asked. Of course, besides this favorite trade, I will also share every single trade that I execute in real time as well. You can simply just copy trade me. A link to Premium will pop up directly on the screen over here. Just click on that. It will lead you to the website. If it's your very first time here, feel free to subscribe as well. I publish videos on YouTube regularly. See you next time on YouTube or see you in Premium. Cheers!